My name is Gary Kawada. I'm a CPA and tax attorney practicing in Los Angeles, California. Welcome to the IRS Masterclass Series podcast number 3. In podcast number 2 of the IRS Masterclass series, I shared with you the factors that cause a return to be selected for audit. In this podcast, I want to explain what the IRS is looking to establish in every examination. The mission of the IRS Examination Division is to conduct audits to determine the correct tax liability. In order to achieve its mission, the service selects returns with high DIF scores, explained in podcast number 2, and a high probability of errors and omissions that can generate additional revenues for the Treasury. Similarly, the IRS official statement on penalties is that they are assessed to promote voluntary compliance and not to generate revenues. However, in reality, in addition to promoting compliance, penalties are huge revenue-generating opportunities for the service. For example, the failure to file penalty can be as high as 25% of the taxes owed. Negligence penalties are charged at a 20% rate, and a civil fraud penalty is 75% of the tax deficiency. International information return penalties can be even higher. For example, the willful failure to file foreign bank account report penalty for undisclosed foreign accounts can be as high as 50% of the bank balance in the unreported foreign account. The first concept that every IRS auditor learns in training is that income is defined very broadly and is from all sources derived unless specifically excluded or deferred by the code. The starting point is everything is considered income that makes you financially better off, unless it's carved out by specific code section, for example, the exclusion for gains on the sale of a principal residence. In certain circumstances, even relief from indebtedness is considered income for the lucky or maybe the unlucky party relieved of debt. The concept of all-encompassing reportable income for U.S. persons, in general citizens and green card holders, even goes beyond the United States to include worldwide income, less a foreign tax credit for taxes paid to a foreign country. As you can see, the Treasury wants to cast the widest net possible to require U.S. taxpayers to report income from all sources derived. Therefore, the network of required information returns reported to the IRS, such as W-2 for wages, Form 1099s for non-employee compensation, and all of the other Form 1099 forms covering other categories of income, foreign bank account reports, bank filed suspicious activity reports, currency transaction reports, and other required domestic and international information returns are used by the IRS to identify income earned or received by a taxpayer. Tests and procedures to identify unreported income, which we will cover in another podcast, are required in every examination. Even when specific information regarding unreported income is unavailable to the IRS can reconstruct the unreported income using a reasonable method of reconstruction, and the IRS can then shift the burden of proof to the taxpayer to prove that the reconstruction is in error. In contrast, deductions, losses, and exclusions from income are allowed only by legislative grace. Personal expenses are not allowed unless specifically mentioned in the code, such as the mortgage deduction, and any business claimed on the return must be an ordinary and necessary business expense and substantiated by a check and invoice. For certain other business deductions, expenses such as auto and meal deductions, expenses must be supported by more proof. The taxpayer has to prove that the mileage and meals was related to a business purpose. Thus, mileage and meal logs are required to claim the deductions. These are the rules of engagement with the IRS. The focus in every audit is to determine if all of the income received by the taxpayer has been reported on the return, and to deny deductions that are personal in nature, do not meet ordinary and necessary business standards, or are not substantiated to the IRS's liking, and that every subsection of a non-recognition provision is followed. That is why it's important for you to understand and use, but only if necessary, the entire IRS process: audit, administrative appeals, negotiation with IRS counsel, and litigation and tax court and collection procedures to achieve a satisfactory result. Of course, most cases don't require going through the entire process, but you should understand what is available to you. We will be covering the entire IRS process in another podcast. The news isn't all bad. Fortunately, the IRS has many different levels of checks and balances built into their system, which helps taxpayers correct technical errors and errors in judgment by personnel and to get it right to achieve its mission of determining the taxpayer's correct tax liability. Thank you for taking time out of your busy schedules to listen to this podcast. I really appreciate it, and we'll see you on the next one.